Hello everybody, my name is Mark. Welcome to another video in my weekly stock review update. And what makes my videos different than other people is that I talk about my own money that I invest. And to my knowledge, I don't know anybody else out there that does that. There's about 1 million people that love to do videos on what the market's doing and what stock you should buy, etc. But I'm the one guy that I know of that is making these kind of videos on a regular basis where I'm talking about my own money that I am investing in the market. As you can see right here, this is my real account with my real money. This is not a fake account, and it's my Roth IRA. So without further ado, let's get started. Now today is Saturday, June the 17th. My other weekly videos I've done on Monday, but I decided to start doing videos on Saturdays because when I do a video on Monday, generally the market is open while I'm doing the video, and so as I'm talking, things like to change. The market goes up or the stocks go down, and I think it's better and easier to do videos when everything's closed and nothing's going to happen, no stock's going to go up or down. So without further ado, let's get started. So first I'm going to go over my GDX position. Okay, so right here I have 100 shares of GDX. It is, let me click on it. Here, GDX is my ETF on the gold mining stocks, and it is my long-term holding. I plan to hold on to this thing for a very long time. And the reason why I plan to hold on to it, I'm going to bring up the chart here and show you something about this particular chart. This is a 10-year chart, okay? And you can see that over the last 10 years, it's dropped, okay? And right here was the recession. And then after the recession, people were buying gold. Gold went to its all-time high, almost $2,000 a share. And then as we've entered into recovery mode and the economy recovered, gold came back down to earth, and now GDX dropped back down to its current value where it is right now, about this value of $20. So this is a long-term holding in case something bad happens again, some great tragedy, then I would expect it to go back up to these levels. So I plan to hold on to this for a very long time. So back to my account here, I have 100 shares of GDX, and I have, again, I like the protective collars. Okay, a protective collar is when you buy a stock or an ETF, and then you buy a put option, which is a contract to sell your investment, and then you sell call options to pay for those put options. So here I got GDX, oops, and right here, where's it at? This here is my put option. Okay, and I spent $435 for this put option. You can see it's down from where I originally bought it, but that's okay because I sold a call option contract, which is this right here, and this I got around 80 bucks for, and this thing has dropped in value $40, so that alone is keeping pace. And then I did an extra thing, which I don't normally do with callers. I sold a put option, and I sold this put option right here at the $18 strike price, so that if GDX goes to $18 or lower, then I would end up buying 100 shares of GDX at $18 a share. But I don't expect it to do that, so I sold this put option to get a little bit extra income to help pay for that put option, the one that I bought, even more. Okay, and both of those, my call option and my put options that I shorted, are both good until December, the end of this year. Okay, so brought in $80 and brought in about $40, so that's about $110. I'm including the subtraction of commission, so that comes off of the $435 I spent on the put. So that brings me down to $335. Okay, and then as GDX moves up or down, then that's going to determine how I'm going to roll it out. Now, last week was an interesting week for GDX, and I'm going to pull up the 10-day chart here. Okay, and you can see that GDX took a drop, and if you have been paying attention to what's going on in the world, you know that on this day right here is when the Federal Reserve raised their interest rates 1/4 point, and so when that happens, then the dollar gets stronger, and then gold goes down, and so that's what happened. Gold dropped, and but that's okay. My position overall is very neutral. I'm pretty much broken even on there, and at some point I am going to have to actually go into my account, look at the transaction, and work out the exact numbers. I have a very fuzzy notion that my dollar cost average is around $23 or maybe a little higher, maybe $24, but I should be more exact about that so I know exactly how much money is coming or going. It's just like when you're living your life, you want to make a budget, you have your 9-to-5 job, and you want to make sure that you're paying your bills and you're not getting into debt, right? Same thing with investing. So that's something that I need to do. Okay. Next is my Bank of America shares, and these are my Bank of America shares right here. I own 400 shares right there, as you can see, and my dollar cost average on my Bank of America shares was $22.93. And real quickly, I'm going to go back to my account. So again, my protective collar strategy, I bought 4 put option contracts. Those are right here. And I spent, what did I spend? $203 for those. So those have dropped in value to $166. So if that's all I did, then I would be down, right? But because I'm using the collar strategies, I sold these 4 call option contracts at the $25 strike price, which means that if Bank of America goes to $25 or higher by July, which is only a month away, then I end up selling Bank of America at $25 a share, which is a $2.07 profit per share, which pays more than pays for the $203, and I collected $42 in premium for that. So I will make $42 times 4. I'll make $160, and the put options that I have right now will still be worth some value. So I will make very good money if that happens, and I really hope it does, because at some point I really want to move my money back to Nugget, which is an ETF on the gold miners like GDX, only it is a leveraged 3x fund. And I've done videos. I have made more money on that investment than any other investment that I've done the whole year. So that at some point I want to get back into that. And I want to tell you the whole reason I got into Bank of America was because Nugget back in April did an announcement of a reverse split, and I didn't want to wait around doing nothing. And so that was a mistake that I made. Looking back, I should have just waited for the split and just stuck with Nugget. But I'm in B of A and I'm doing okay. I'm making money on B of A, but I know I would be doing better if I would have just been patient and waited for my chance with Nugget. So anyways, back to Bank of America. So 400 shares of B of A, and then 4 put options. As I explained, spent $205, but I sold these 4 call option contracts. Okay. Now, looking at the week here, going to pull up the 10-day chart and drawing my trend lines. Okay, so this was the day right here, right around June 14th, a couple days ago, B of A dropped. So the Federal Reserve raised interest rates 1/4 point, and B of A dropped, and then it recovered. Right here, it recovered, and then it's been kind of holding steady, and that's very good news for me. And so I'm planning to sell some put options to bring some more income. And as I look at the put options, I'm even going to pull up the option chain. I want to go maybe 2 months out. The thing about B of A is it has low time decay, low extra premium on their puts. Okay, a stock like Nugget, like this here, 62 days out. B of A is at $23.42. I'm looking at the $22 put option here, right here, and I see 35, the bid $34 and the ask $36. So that is about a 1.5% return in 2 months. Now on Nugget, I can guarantee you the return would be more like around 10% or 12%. Okay, and that is unbeatable. That's why I like Nugget so much. But this is okay. The thing is, I don't expect B of A, and earnings is coming up next month in July, but I'm not even worried about the earnings. I think I'm probably going to sell these put options probably in the next few days, next week when the market opens, and just to make some extra income. And if you look at the chart, let me go to the chart here, and I'm going to pull up a longer term chart, 6-month chart. Actually, I'll even go a little longer. I'll go 3 years just so you can see it easier here. Okay, you can see that their support is right around $22, and so I feel very comfortable selling call options at that $22 level. I don't expect B of A to be going down here. You know, Donald Trump is not getting impeached. Nothing crazy is going to happen. The Federal Reserve raise the interest rates. Banks and financial stocks will continue to do well, even if it's just slowly but surely. So that's my next plan, is to start selling those put options at that level, and I really have very little to worry about, and I am not worried about the earnings. And just for kicks, let's look at see when the earnings is. There you go, July 18th. And a rule of thumb is well, I can't speak for everyone, but a lot of people do not like to own stocks during the earnings report. Let me get that out of the way. Okay. And so they either like to get out, or they like to do some very conservative things, but not me. I'm not at all worried about Bank of America or the bank stocks, and you can see their let me see if I can find their earnings per share. Would that be in the fundamentals here? Where would it be? Here we go. Their earnings per share right here. No, that doesn't have it. Where would that be? Sorry about the delay here. I was hoping to find the earnings per share, but not finding. Maybe I got to go to the summary. Yes, okay, here it is. The earnings per share is in the positives. They got a low PE ratio of 14, which is lower than most of the other banks. So this is a very safe stock to own, and I think buying this stock and using the protective collar is a good way to make some easy money. So that's where my money is, but remember, at some point I'm going to get back into Nugget. Ticker symbol NUGT. Nugget. So back to the chart here, back to the 10-day average. Federal Reserve raised the rates, Bank of America dropped, and it's holding steady, so not worried at all. Now, that's my investments overall. Overall, my investments are pretty flat. Best case scenario for my Bank of America investment is for Bank of America to go to $25 or higher by July, right here, by July of 2017. If that happens, then I'll make some good money. If not, then I will sell another covered call, or there's actually several things I could do. I could sell half my shares and wait and then sell covered call, or I could buy some more put options and then just start selling lots of put options, maybe aggressive put options, maybe at the $22 or $23 strike price, because I'll have lots of leverage that I can do that with. Many things that I can do. Or I could just get out of Bank of America altogether and then just open up a position on my remaining put options, which are good till June of next year, and maybe sell a $19 put option. And let's see what I get for those $19 put options for next June here. 363 days. Doesn't even have the 19s. It has 18. So I would, here you go, I would get $55, and that would be my best case scenario is if Bank of America dropped to $18 by next June, then I would make very good money. But if not, then I would just make $200, which is a 1% return currently. But it would free up all the money that I have tied up in Bank of America. And total money I have tied up in Bank of America is, survey says, where is that at? 400 here. I guess I got to go to positions to find that out, don't I? There you go, $9,372. So it would be nice to have that money to get into Nugget. So I might actually do that. I might just sell out of B of A here by July, and then just maybe sell a put option at that $18 level and make some easy money. So that's the safest thing I could do, and then I could get back into Nugget, which is what I really want to do now. So that's it. for my positions. Now, I want to talk about one little wrinkle of an event that happened last week, and I'm going to pull up Amazon. Okay, now if you look at Amazon, this is a very fun stock to keep track of, and honestly, I wish I had the money to buy 100 shares. I wish I had $98,000 that I could buy 100 shares of this and then do my protective collar strategy on this. That would just make my day, but I don't have $98,000. You saw what I got. I got $13,000, and I got another account that I haven't even touched. It's my margin account. I'm sticking with my Roth because I like tax-free. I like not paying taxes. But without digressing too much, back to Amazon. Pulling up the charts here, 10-day chart. Very fun stock to keep an eye on. Okay, now this here was last week during the tech sell-off. Techs went down, banks held steady and then went up, but the tech sell-off happened, and then it recovered, and then it continued, and then look at this, it even gapped up. And guess why Amazon gapped up? The answer is because Amazon did a merger with Whole Foods grocery store chain. Okay, so they bought out Whole Foods, and look at what happened when that happened. Okay, let me bring up Costco here. I'm bringing up Costco, and let's look at what happened to Costco on the day that they did that. So pulling up their chart, 10-day chart. Oops, Costco. Now we're talking about a stock. Okay, this Costco, it has a market cap of $73 billion. Okay, so think about that. $73 billion stock drops all the way from $180 down to $167 a share. That's like a 10% drop. That's what is it? No, not quite 10%. I guess 180, 10% is 18. That'd bring it down to 162. So that's like a 16 or 17% drop on a $73 billion stock, all because Amazon merged with Whole Foods. Okay, and that's not the only one that got hit. Here's a grocery store, Kroger's. You might have heard about this one in the news. I feel sorry for anybody who owns this stock. Okay, this stock, this was just on bad earnings, and this was on the merger. So from the price of a $30, now they dropped down to $22. Okay, so that is a more than a 25% drop on them. So grocery stocks right now is really not the place to be, at least not last week. Now, maybe these stocks will bounce back. Maybe they'll recover. Who knows? But one thing I can tell you, I wish I had the money to buy Amazon 100 shares and put on my protective collar strategy. I think that's the best thing in the world. And I'll show you what I would do if I had the money to buy Amazon. Okay, I'm going to pull up the option chain here. Now, first thing I would do is I would look at the long term. The general rule about collar strategies is when you're buying your puts, you want to buy for the long term. And when you're selling your calls, you want to sell for the short term. The reason is you make money on the time decay. Okay, so looking at these put options, I'm going to go out of the money. And I'm going to look at, now, Amazon is trading at $987 a share. Almost $990 a share. And I'm looking at this $900 put option right here, which looks like you'd have to pay about $8,000 for it. Okay, now think about that. Okay, that sounds like a lot of money, but if you wanted to buy 100 shares of Amazon, you would need $98,000. That's what I keep saying about stock options. It gives you leverage like crazy, and that's why you need to use stock options, in my opinion, to become a successful investor. It hedges you like nothing else I've ever seen. So you spend the $8,000. First, if you had the money, you buy the 100 shares of Amazon, you spend the $98,771, and then you spend an extra $8,000, and you buy that Amazon stock. I'm sorry, the put option. Okay, and you spend the $8,000, and you buy that put option right here, right there. Come on, right there. There we go. Okay, so you buy that put option. Okay, now you've done that, and now for the next $580, for the next 580 days, you have protection. And if Amazon drops below $900 a share or lower, you can sell out at $900, and you spent $8,000. So really, to make money on the put, it has to go all the way. It has to go all the way down to $820. Okay, a share. But if it did that, you would be protected. That's the whole point. Now, that's expensive, right? You don't want to just throw away $8,000, right? So what do? You sell call options, okay? And so first I would let's look at 90 days. That's a reasonable time amount, okay? Now, you have to do a little math, okay? You spent the 100 share, I'm sorry, you spent 98,000 whatever dollars to buy the 100 shares, and then you spent 8 grand to buy that $900. So you have to add the 8 grand, or I should say, is it add or subtract, whatever. You have to add the $8,000 to the $987, and you get $1,067. So if Amazon went to, let's say, $1,070 a share, then the stock appreciation pays for the $8,000 you're throwing away on the put option. Okay, and so what you want to do is you look at call options at that level. So here are the call options right here. $1,070 call option, okay? And when you sell this, you're giving somebody else the right to buy those shares from you. So what will happen is if Amazon hits $1,070, you will automatically sell your 100 shares at $1,070. You will make, you're buying it at $987 here, so $1,070, you will make $83 a share. Plus, look at all this premium you get. You're getting this, looks like, let's say $1,900. You will make $1,900 premium on your $987 investment. So $987, what would that come to? About a 2% gain, 2 or 3% gain. Let's see, 98,000, 10% would be $9,800. 1% would be $9,800. So about a 2% gain right there. And you would do that in 2 months plus all that stock appreciation right there. So it's a very conservative way. I've always said protected callers are a very conservative way to make money, okay? And of course, Amazon is a high-flying stock. You can go up and down at the drop of a dime, as you saw in that chart. So that's what I would do right there, is I would buy 100 shares of Amazon. And here, I would buy this, let me go down here. I would get this $900 put option. Oops. I would get that $900 put option. And then I would sell this, where's it at? I would sell this $1,070 call option and collect all that money. And then I would automatically sell out, and whatever, and I would make all this premium. Actually, I'd make a lot more than 2%, because this, let's go down $80 from 900, and you go down to 820. So it looks like I would still have $5,000 of value left on my put option. So I would only lose $4,000 on that. So that's an extra $4,000 that I could add to my winnings, if you will. So that's what I would do. I would, if I had the money, I would buy 100 shares of Amazon. I think Amazon is the best stock in the whole market. They're just taking over everybody. And I get 100 shares of them. I would buy the $900 put option, and then I would sell. And I would buy this $900 put option right here. Spend the $8,000, and then I would sell this call option. This one here it is. I would sell this call option, which would help pay for my put option. And that's how protected caller strategies work. That's the way that you can buy stocks and you can go to sleep at night and not have to worry about losing all your money. So anyways, I hope you guys enjoyed this video. Thank you for watching, and I will see you next week in the next video.